Imagine waking up one morning to find the banks are closed. You grab your phone to check your balance, and the app won't load. The ATM down the street is out of service. Shops are open, but no one wants your debit card. Gas stations demand cash. At first, you assume it's just a glitch, but then you notice the mood in the streets. People are lining up outside shuttered banks. Supermarkets are full of customers with carts stacked high, paying with crumpled bills because plastic is useless. The news blares updates. The financial system is under emergency review. And then the thought hits you like ice water. Your money isn't tea. Where you thought it was. It was always just numbers on a screen, and the screen has gone dark. This sounds like a dystopian novel, but it's not. It has happened before, in countries that thought themselves modern and secure. And when it happens, the rules of wealth and survival shift overnight. Take Argentina in 2001. The government slammed the banks shut in what they called the Corralito. For ordinary Argentinians, it was a caje. Cash withdrawals were capped at 250 pesos a week. Dollar accounts were forcibly converted into devalued pesos. In just weeks, savings for homes, businesses, and retirement lost half their real value. Middle-class families were thrown into chaos, and Argentina is not alone. In Cyprus in 2013, the government froze bank deposits as part of a bailout. Depositors with over 100,000 euros woke up to discover their accounts would be raided to rescue failing banks. In Lebanon, in 2019, years of corruption triggered capital controls. Banks limited withdrawals to a few $100s a month, no matter how much was in your account. Savers stormed branches, so may wheat gaunts. In each case, the story was the same. What you thought was your money turned out to be theirs. Even in the United States, the banks have closed. In 1933, President Franklin Roosevelt declared a nationwide bank holiday. For 4 days, every single bank shut its doors. The common thread is that banks don't hold your money the way you think they do. They operate on fractional reserves. For every dollar you deposit, only a fraction stays in the vault. The rest is loaned out. When too many people demand cash at once, the illusion breaks. So why does this keep happening? Because the core of our financial system, fractional reserve banking, is both its genius and its Achilles heel. Banks don't just store your money, they multiply it. If you deposit $1,000, the bank might keep 50 and lend out the rest. That loan becomes someone else's deposit, which is then lent out again. $1,000 becomes 10,000 in circulating credit. It's a machine that fuels growth, but it's also a house of cards. If too many people ask for their original 1,000 back at the same time, the bank simply doesn't have it. This is why confidence is everything. The system works as long as people trust that the doors will stay open. But the moment that trust falters, a run begins. It's like fire in a crowded theater. One scream, and survival becomes a stampede. Governments know this. That's why in crisis after crisis, their instinct is to protect the banks, not the individual saver. When Argentina imposed the Corralito, it was to stop the banks from collapsing. The ordinary citizen was forced to underwrite the mistakes of politicians and bankers. Deposit insurance, like the FDIC in America, sounds like protection. It guarantees accounts up to $250,000. But if every depositor in the country rushed to claim that guarantee, would the money be there? No. The insurance fund is a fraction of total deposits. Its real power is psychological. It's a placebo designed to keep you calm. And in our digital age, the problem has deepened. We're more dependent than ever on centralized systems. If the server goes down or the institution freezes your account, your wealth is suddenly just digits in limbo. The ripple effects are terrifying. Businesses can't pay workers, so layoffs spread. Supermarkets can't pay suppliers, so shelves empty. What starts as a financial problem cascades into a full-blown social crisis. This has happened across the globe, and if you think it could never happen where you live, remember. Those are the exact words spoken in Argentina, Greece, and Lebanon, just before it did. Stability is an illusion until the day it isn't. So, what can you do? The answer is not stuffing cash under your mattress. The real strategy is resilience. Diversification is survival. Having assets in more than one form, more than one institution, even more than one country, can mean the difference between paralysis and mobility. Real wealth isn't just what you earn, but what you can actually access in a crisis. Gold, real estate, and cash reserves aren't old-fashioned ideas. They are lifelines. The lesson from Argentina, Cyprus, and even the United States is simple. Do not confuse access with ownership. If your wealth only exists at the mercy of institutions, then it is not truly yours. To build financial freedom, you must look past the illusion of safety and prepare for the moments when the system falters. Because one day, the question might not be, what if banks shut down tomorrow? But what do I do now that they already have? If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.